Dan Michaels, co-founder and managing partner of Stockdale Capital Partners. We are a vertically integrated real estate private equity firm founded about 15 years ago in Los Angeles, now investing nationally across asset classes as a fund manager, asset manager, and property manager, where we're the owner-operator on behalf of about $3 billion of assets and growing.
All right.
Yeah, obviously, real estate's been in a bit of a depression, or a lot of a depression for the past 5+ years. You've had multitude of black swans that, not the least of which are quintuplative interest rates, which have impacted real estate in what I call the Great Reset and the Great Chase for Liquidity, which has not only been in the underlying assets on behalf of financing or refinancing, but also in fundraising on behalf of private equity counterparts that are trying to garner capital to take advantage of the industry. And so it has been a pretty sizable slowdown, which for the first time, really over the past 6 months, although it feels like every month there's a new headline that starts to create some tremors, but it feels like it's starting to unlock the log jam that's been there for a long time. For a long period of time, there was no support in debt capital markets and a schizophrenia in financing and therefore in deal flow across virtually felt like every single asset class. And in the most extreme asset classes like office, which were in question post work from home, there has been a thawing in the context of those debt capital markets recently that has shown some improved capital markets activity. But there have been pockets of resilience. We've seen it in medical office as an example, in lifestyle retail as an example, even in pockets of multifamily. Now, there's a decoupling where there may be resilience in operating fundamentals, but not necessarily in capital markets or valuations. And that's where we come in as kind of a distressed turnaround investor or special situation investor, is go out and use our liquidity to take advantage of transactions where the fundamentals are actually quite strong, but the capital markets aren't necessarily there to support it. Well, gone are the days where interest rates make you look smart, which I think was what a lot of people have been riding the coattails on for a long period of time. And the concept of market beta is now over, and you're now looking at the concept of operational alpha, meaning bringing what we call alpha at the property level or performance at the property level to really impact NOI change. In an environment where there is no cap rate compression, where are you getting your NOI growth? Where are you getting your value add? And I think that's where being a vertically integrated owner operator gives us the advantage, because we are the allocator and the operator put together, and the ability to come across asset classes to generate the best value gives us flexibility. If you're an office investor and you can only invest in office, it may not be the best time to be investing in office. And that can go, same for life science or any other asset class. And so our ability to dip and dive and be flexible and then create value as an operator on behalf of our institutional commingled funds is where I think we have our edge. And I think that's what the market speaks to. It is a stock picker's market where you've got to pick that specific asset and that specific submarket, because general valuations driven by Fed funds is not has, again, generally saved people when things haven't gone well. You really have to bring progress operationally to drive performance. And that's where I think the market environment is, starting to create have and have nots in terms of performers. You either have the operational capability to impact change, or frankly, you're getting left behind. Yeah, although it depends on the asset class. I mean, we've seen market fundamentals in multifamily be very strong in one very specific submarket of like a Scottsdale and be very bad in another submarket 20, 30 minutes away. And so you really not only have to have the operational capabilities to impact change, you got to be a little bit of not a little bit, a lot of a market expert to try to figure out where those fundamentals are improving. There is benefits to markets of migration, like a Dallas, like a Scottsdale, like a Charlotte, that are improving fundamentals just more broadly for those cities. But you can't even just rest on that MSA. You have to dig in to understand what's happening, in an uptown Dallas versus a downtown versus a South End in Charlotte versus Kierland versus Chandler, entertainment district, if you will, and Scottsdale. Each one of those has its own dynamics. And I think the important for us is because we go across asset classes, we can see how these particular submarkets are evolving. We can see new retail coming to market or new office being built and hopefully in some circumstances successfully being leased, what's happening with medical care and delivery, and start to think about the ecosystem and how that's impacting our investment opportunities. But certainly the markets of growth are continuing to still see in migration, and will continue still. I still think pockets of growth. So we've been focused, like I said, Scottsdale, Dallas, Charlotte, to name three. Yeah, it's a good question. I mean, I don't think there's any replacement other than either having lived there or having grown up there, having invested. Like it's really an intimate, organic relationship that is born out of investing in these markets for decades and seeing again how Dallas has evolved or Scottsdale has evolved or Denver. It's very hard to replicate. And again, I think the benefit for us is because we can look at all asset classes, we can see, when a mall is being redeveloped, we may have looked at buying that mall or retail center when new multifamily is being developed, when new corporate activity in office. And because we're investing or considering to invest in all those asset classes, we can gain a deeper insight into those submarkets as opposed to either looking at one asset class or not necessarily being exposed to those particular cities. And again, when you think about, it being a quote unquote stock picker's market, you have to be really, really specific on that specific asset class, that specific asset, that specific submarket. And that's where becoming kind of a market expert, on the ground, feet on the street operator really starts to pay off because you can distinguish the difference between, a La Jolla, a Temecula, a Thousand Oaks, a Chino Hills, a Westwood, and frankly, until you've lived through those various pockets, it's not always easy to distinguish what's occurring in each one of those. And so part of our growth as a firm, we've invested heavily in new talent through this downturn. We've nearly tripled our employee count, is also growing our presence where we have offices in Scottsdale and Denver, in Dallas, now moving into the East Coast through New York to have more local presence so we can not only garner good talent in each one of those markets, but market insights into real estate and the underlying trends of the submarkets. Yeah, by far and away, I think the greatest opportunity is in retail. You have like 2 or 3% vacancy. You have zero new supply. You have a stock that is stuck in the 1990s. And the proverbial hot topics of retail, which no one are going, hot topic, the tenant, if you will, which like is still very much like of the past, being upgraded into new and improved retail tenancy. And if you can bring something successfully that speaks to that community and provides food and beverage and experiential retail and fitness, you're seeing incredible demand, tenant demand. We've seen it across our portfolio. You are seeing a pretty severe supply demand imbalance for medical office up against aging population. We are still very cautious of supply when it comes to certain markets for multifamily. For office, I think in the most extreme, you're seeing a massive oversupply and fallout in life science. And so you're kind of almost seeing this wave where some sectors have remained resilient, and frankly, the supply demand dynamics are stronger than others, and then others are still recovering as you kind of go through the wave of recovery. But we've seen, it's odd, like for the long time, a lot of malls were getting just absolutely puked out at extreme valuations. We'd show up to bid processes or maybe two bidders, and you'd be buying these things at like 12 caps. And then we'd own them and we'd say, hey, we're put some money in turning them around. And the tenant demand looked nothing like the valuation that we bought it at. Normally if you're buying something at a 10, 11, 12 cap, it's because that's going to go to like a 5, 6 cap because all the tenancy is going to run away. You saw that in San Francisco office as an example. But what we've seen is actually the retail. There's been kind of this like baby with the bathwater on retail valuations, yet the tenant demand for the right owners and the right locations still remains very strong. So we see a total disconnect in terms of supply demand from a capital market standpoint, where there's been a good amount of supply of retail, not many bidders, interesting valuations as a result, and then the opportunity to come in at a great basis, return those things around where tenant demand remains very strong. So we like the dynamics there. Some markets, are just have been oversupplied. Austin multifamily as an example that's seen, pretty severe supply glut that's impacted. Of course, if you buy anything at a 3 cap and it doesn't turn out, you're going to be pretty exposed. And so that's working through the supply, oversupply, which will take several years to work through. So again, our ability to be flexible, look at a bunch of different markets and asset classes allows us to think through the best risk-adjusted return and the best supply-demand exposures and where we're seeing resilience in underlying asset classes. I think that allows us to, and by the way, we also focus on equity and credit. So if we don't like the equity exposure, we can think about the credit exposure through a stretch senior or a mezz or pref or something. So, but yeah, retail, medical, multi in certain markets, we're seeing certain resilience, and we like the supply demand dynamics of those first two, retail and medical specifically.